Hey, good morning. This is Jim Harvey, and this is your Money Week. In this session, I want to talk about inflation. Are we looking at moderate inflation or runaway inflation? And I've been in the business 40 years, so I've listened to these paranoid folks about inflation. Oh my gosh, it's runaway inflation and that kind of thing. And if you were a German citizen with parents who lived during the 20s, I can understand the fear of inflation, where they used to use literally wheelbarrows full of money to go buy bread. But the question is, let's break down inflation a little bit more deeply, because I think people are freaking out a little bit too much. Now, for example, I love this website, despair.com, and this is a picture of a guy whining on the floor, grabbing his knee, going, if you expect to score points by whining, join a European soccer team. Okay, so now you know what I think about people that, oh my gosh, the world is ending, the inflation. Let's break it down. First of all, the purchasing power of the US dollar from 1980 to 2021 has declined by 70%, but it's also a 42-year period of time, so not surprising. But what is it inflation average by decade? It's 7.4 in the 70s, 5.1 in the 80s, 2.9 in the 90s, 2.6 in the 2000s, and less than 2% in the 2010s. So if you look at the 30-year average, it's been 2.1%. That's been really low. Just to give you a sense, I'll show you what it was the year before or two before I got into the business. Now, most of us think about the inflation number as if it's an unchanging indicator, but it's really anything but. In 2014, the U.S. Bureau of Labor Statistics, which prepares the CPI, highlighted the first 100 years of the CPI, and what is covered has changed over time, as has the percentage each major category represents in the CPI. Now, back in the 20s, they tracked the price of ice. Ice. Why? Well, people didn't have refrigerators. They had what are called ice boxes. I remember my parents used to call about the ice box. So obviously tracking the price of ice was important. There have also been some other major things that would raise question about any long-term figures that people use to describe inflation. For example, war. Prices rose sharply in World War I and World War II. Why? Because there was a scarcity. So they installed price controls as well as rationing. That's obviously going to affect the price of those commodities, which, had they not put those price controls in or done rationing, there'd have been rampant inflation. It also, during the Great Depression, deflation reigned, where things cost actually a little far less. And since World War II, the Korean War being the only exception, most Americans have seen nothing but inflation. The 12-month change in the all-items CPI went 54 years without a decrease or deflation, from August 55 to March of 09, March of 09 being the credit crisis. From 1941 to 51, inflation averaged 5.8%, with the largest 12-month increase between March of 46 and March of 47 of 20%. So when you see numbers that we've been seeing lately, like, oh my gosh, it's up 8%, yeah, it's higher than it's been, but it's also a rolling 12-month period. That's the way they do this. They look at it every month. What was it 12 months ago? And then next month, the same thing. And so there are going to be some spikes. From 51 to 68, inflation averaged 1.7%, with the largest 12-month increase being 4.7%. Between 68 and 83, inflation surges and price controls reemerged under Nixon. However, inflation averaged 7.3% annually. And then 83 to 2013, it's averaged 2.9% annually, with the largest 12-month increase being 6.3% previous to this year. Now, you look at the numbers going way up and you go, oh my gosh, if you were just looking out here from 2015, where inflation was literally zero, or 2020 when it was about 1 point something percent. Oh, it's gone up a lot. It's gone up more than double. Yeah, but it peaked in 1980, which is 3 years before I got into the business, at 13%. Now, we talked about consumers being such an important part of the of the economy of the United States. Is 70% of our economy is driven by consumers, and money stock is as high as it's ever been, which is huge. And we have $21 trillion in circulation. Now, here's a great way of breaking down inflation. This is a really important slide to pay attention to. This was back in March, where gasoline was up 47%. Used cars were up 32. Remember, for 35, sorry. My gosh, you could sell your Subaru for more than it was worth, by 50%, even 6 months earlier. And you see housing down here at only 4.4%. Well, that's a problem, because one of the differences is that used cars represents only 3% of the index, whereas housing represents 31%. So we think inflation is going to be higher for longer than people want to see. And there are some reasons for that. First of all, housing increased only 4.4%. It's 31% of the CPI, used cars only 3%. But the CPI reported housing up 2.5% in 2020 and 3.5% in 2021. However, we know that the median average home price was up 28% since February of 2020 through March of 2022. Why is the number so disparate? Because housing price increases have always lagged by 12 to 24 months before they appear in the calculations in the CPI. So the conclusion is the CPI numbers will be higher when these actual housing price increases are incorporated into the data. But we also know more recently that because interest rates are higher, home prices have been dropping after those meteoric rises in 2 years in 8 of the top 10 urban markets in the US, Seattle being one, San Francisco, New York, et cetera, Boston. And so even though we haven't seen the rate, the rise in the numbers yet, the housing price numbers are actually are going down. So we haven't seen the raise nor the decline. And so our expectations are probably 5 to 5.5% by year end. That might even be low. In 2023, 4+. And I think long term, it's going to be higher than the 2.1% it's averaged over the last 30 years, probably in the 3 to 3.5% range. So breaking it down, remember that just looking at these numbers, you could be distracted by, oh my gosh, used cars are up 35%, but they only represent 3%. So focus on the ones that really make a difference. The other thing is that I recently heard from someone that the housing numbers, if you remove them from the CPI, everything else is clicking along around 2 to 3%. So I think we're going to have a spike in inflation for the next probably 18, 24 months, but that it will settle back down as we make our way through the recession and come out of it moving forward. What does well during high inflation years? Well, this is interesting. What doesn't do well are things at the bottom here, like T-bills, long-term government bonds, corporates, and then in the sectors of the economy or in sectors of the S&P, large cap growth stocks don't do as well. Telecom has done really poorly, and quite frankly, that's exactly what we're seeing right now. Whereas at the top, you have small cap value stocks, energy stocks have done well, large cap value stocks. We think large cap value stocks, which are big companies that pay dividends, that don't have big growth. I'm talking IBM, Heinz, General Mills, those kinds of companies tend to do well because they have products that will benefit from increasing prices. People flee to those because they're considered safe. Here's another way of looking at it, and this is commodities, but as you can see, this is what's called a Callan chart, where it says year over year, what is the best performing, the worst performing asset class. And so you can see commodities here, second from the bottom, and then, the worst, and near the bottom, near the bottom, near the top, near the bottom, near the bottom, in the middle. So it goes all over the place. The reason I bring this up is year to date this year, when inflation is now more of a factor, almost across the board, commodities are up substantially, especially energy, which is up 50%. but even things like wheat's up 18, soybean up 18, soybean oil is up 18, soybeans are up 15, corn is up 22%. What does that mean? Well, I think it means that we're going to have inflation, but I don't think it's runaway inflation. With a strong labor market, that's going to, of course, push up wages, but the question is for how long? I wouldn't be opening a vein or writhing on the ground like a bad soccer player talking about, oh my gosh, runaway inflation, the world is ending, because it's not. Well, this is Jim Harvey, president of Opus 111 Group. I hope this has been informative. I encourage you to go to our website, opus111group.com, particularly to our Learn page, where you will see podcasts like these, audio and video podcasts like these, written podcasts and blogs to help educate you on sorting through the hype to get to the facts that you need to sleep better at night and feel comfortable about your investment plan. Have a good day.